Okay, so what we haven't talked about is what's called active and passive. I guess active and passive range, not active and passive ranges, but I guess you would call them. I always have to think of names for this stuff. What do I call them? I call them active positions and closing positions. So that's what we're going to call them: active positions versus closing positions. So an active position is something that actively is entering a new position. So this has to do with how you see moves break down, the degradation of something where you see these kind of big moves like this, and you go to these smaller time frames, and you can see these larger moves down in the charts. So when we talk about active ranges, or sorry, not active ranges, active positions and closing positions. Definition of an active position is a position that is opening for the first time. For example, right here, you'd have active shorts coming in. So an active short means that this person is not in any orders. This is not a contract that's closing. This is somebody who's opening up a new short to look to close in profits somewhere in the lower ranges. So they don't have a contract they're closing. And the reverse of an active position would be, so an active short would be a closing position. So somebody who has entered, any level down here, or any one of these moments, right? Like you would have, I don't know, just find your hold levels here and find you have, so you have your hold level here. And an active position opens here because you wouldn't have positions closing on this level. It wouldn't, unless people just don't know what they're doing. Well, I'm sure you have people closing positions. Again, they just don't know what they're doing. This is something where you have active positions opening, right? So this is a moment where you're saying, okay, my positions are going to actively be open. So I'm not, we're right here in time. Let's bring up the replayer tool. We're here and we're sitting here saying, okay, here's my target. I'm going to put a contract there and I'm going to open the contract and I'm going to pick a target. So I'm actively opening a contract. My contract has been opened. Now I need to find out where to close it, right? So my position holds. We start to move up and so be it. You have an active position now that needs to be closed somewhere. So an active position, you're going to find a target on your charts. We can use this. That's fine. So you'd have an active position here and you'd be setting a target somewhere in this range here to close this position. So there's a difference between active positions and positions that are closing out, right? People here all this whole way, and this is where you're going to see. So if we actually rewind this for a second here, this is where you're going to see people who are in shorts are now going to start thinking about, okay, what do I need to do to get out? So for example, you have a range right here that represents shorting, right? So possibly people would be shorting this level here. So we'll use, we'll use red. We'll do conventional red for shorts. And we'll do green for longs in this. Change this to green, like so. Perfect. Yeah, this is a nice green. I like this one. Okay, so we're going to do that. We're going to make it a little thicker. We'll do this. Actually, we're going to make it thinner. So you have positions wanting to enter here that are longing and positions wanting to enter here that are shorting, right? So you are going to have a bit of a staggered setup here, right? So you have two positions, right? You have shorts entering here, longs entering here. As this move develops, you have both sides of the contracts open, okay? So right now, you're in this move. You've just entered your long positions, right? You've just entered long positions. Right here, people will make a decision to either start closing their contracts, right? So if we actually pull this back to here and we look at this hold level, we can say, okay, this hold level is going to hold up the move. If it does continue to hold up the move, you're going to have the better people who are traders. They're going to start closing these contracts that they took and these contracts that they took. So they are in active trades right now. Or sorry, I should say, they have actively entered a short here or here, and they have to close their contract somewhere. So as this price stabilizes, now they probably won't see this level because I don't know who would be, well, you know what? It's actually not terrible profits. It's not horrible. You've got this to this, you've got 50%. So actually it's not bad. And that's actually a decent cause for closing your position. So people have entered shorts. Maybe they got lucky enough to get off the top of this here, which would be, I'm sure, another level back here somewhere. I'm sure it would be this right here. or yeah, that one there, and then the high side of the range right here, right? So you've got different spots where people are actively opening new short positions up here. Okay, you have people who are actively opening up new long positions down here. As this move is developing, it's not that this thing is starting to pump. Okay. As this is moving down, this is starting to move up. People will close those shorts, right? So you have all sorts of people. You're going to have people entering on this level short. You're going to have people entering on these levels up here short. You're going to have people entering here once the move is already half over. You're also going to have people entering here because they think, oh, just about to start a huge move down and they're actually late to the party. So you've got all of these shorts. So you've got a marquee of shorts that are everywhere from even these higher levels up here. You're going to have shorts from up here. You're going to have shorts from up here that never got fulfilled. You're going to have shorts from this range. You're going to constantly have shorts on the book that are going to comprise of where this thing moves left and right and up and down, right? You're going to have a position of different shorts that are constantly adjusting what's happening. So this is not so much about understanding, hey, there's levels that we short and long. This is about understanding where shorts will close their position because the best shorts will have closed it right here, which actually also end up holding the move up. So shorts that need to relong, right? If enough shorts relong this level here, it will actively hold the position up. So you might not even see active traders getting in here. This can be a combination between active trades, so people who are opening new longs, and people who are in shorts that are looking to take their profits, right? Or know that this is going to hold and move up, and they are looking to exit. So it's not that people are actively buying this up. This is that shorts are closing. So the closer you move up, the faster this thing will compound higher and higher and higher. Because what's happening is the quicker you move up, the more shorts that are going to push the price. So this isn't the case of people buying active positions. Now you have some of that. People will enter here and they'll enter here and they'll enter here. So these are the people who are obviously not trading very well. They're FOMOing into the move. They see a huge move up and they think, oh, it's time to go. We're moving to the moon. It's turn on the spaceship, put your bags put your suitcase in the cargo shuttle with the rocket fuel, right? It's just like kind of silly because there's no reason to enter this trade as it's moving up. There's just no common sense to it because what you're going to do, and as time goes on, these arrows are getting bigger. You're going to have more and more contracts closing as this thing goes. So as this is starting to breach its levels, you have to realize that it's not active trades coming in; it's contracts closing. So here you have contracts closing and the people who refused to close their contracts, right? So then you go one more candle and this move starts to hold. So people will have like kind of a round two. This is kind of like round one where people are closing their active position. So shorts are trying to relong. Once this starts moving up, people start smashing either the market button or the limit to buy this thing up. That's round two. This is like round one right here. We're just going to draw this like that. Round two is right here where people start to move the price up and these shorts are closing their position. People will hold this and also reshort this. So now we're going to do it like this. We're going to go like this, a number one right here, right? But this one is going to be a little different. You know what we're going to do? We're going to do this a little cleaner here. Let's do it like this. Let's go with the text tool. We're going to go one, that, and that's fine. So you have shorts, and we're going to use red for this because this is where shorts are going to exit their position. So for this, we're going to use red. So we're going to go like this. One, that's the first spot shorts will exit. Two will be right here, right? That's where shorts are exiting. And then you're going to have one like this, new shorts coming in on this level, which also just compounds the amount of moving up that this is going to do. So new shorts are going to say, oh, here's the level. We just hit the top. We just double topped, like the famous double top candle pattern, the garbage that doesn't make any sense why it would even exist. Oh, we just double topped. We should probably reshort again. Meanwhile, you have another round of contracts about to close as soon as this thing starts to hold because they see, oh, it's not moving down. I need to exit and profit. So all these people, not only from back here that shorted this, that are stubborn, that shorted up here and want to secure profits, that shorted all of these different levels in here, right? That's also shorted all of these different levels in here. These shorts, these greens, as these will be active shorts in profit, right? This one is no longer in profit, right? So he probably exited somewhere up, or most people don't exit in profits. Most people actually exit at a loss because they're scared and they just like to hold their coins and their tokens. So this guy's already probably in a loss. So he's going to exit relatively soon or just simply get liquidated. But you see, the difference here is that you've got the same occurrence happening. You have new shorts opening and none of those shorts closing because people think, oh, short, we're moving down to the bottom, 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 short, we're moving down to the bottom. And then even here, you're going to have another one happen right here. Shorts, oh, we're moving down to the bottom. Meanwhile, you have phases of shorts that are going to be closing like this. So the number 4, the next part of shorts that are going to close is going to come in a large wave of shorts, right? This is going to come in a large way because the magical double top is failing and it's a triple top that couldn't form. So now the triple top can't form. It's going to have a breakout, right? It's just silly thinking because how many shorts are re-entering this? So how many active shorts are entering this versus active longs? So that's the key thing to understand here. We don't have active longs. Your active longs happen right here. So active longs, we're going to put in pink. The smart active longs happen right here. And we're going to make this one a little different. We're going to go like this. We're going to go bold, italicized, and we're going to make it hot pink. Yeah, that is hot pink. And we'll do a green border. Yeah, that looks good. Maybe not the green border. That's a little silly. So we're going to go here. Oh, we'll do no bold, just italicized. This is active longs re-entering the position. And then maybe you have another phase of active longs that starts to move this thing once this is actually moving up, like once you actually stabilize a level and you're starting to move up, all indicator people are starting to go, the MACD crossers, this and that, they'll start entering up here, all that other junk. But really what you're seeing here is you're seeing an over liquidity of long positions because you have shorts actively exiting this trade. So as this goes, now those people, they just flooded out of this trade because now they say, oh, the position is compromised. There's a triple top, and people will still be opening shorts here who are quickly going to panic out. So the higher this thing goes, the faster you have shorts relonging the position because people will try to short to move against the move. It's human nature. It's just the way people trade, right? Because they want to catch some kind of top or bottom. So now, once you pass this level, you can imagine the amount of longs that are going to come into this move because everything will now be closing. There's no reason, unless they're getting liquidated, there's no reason for any of these to be in the position. So imagine all of these shorts, all the people who are still taking the smaller part of the profits, all the people who are about to get liquidated, all the people who have just entered this trade thinking we've got a triple top, hammer forming or whatever they call these things. I'm not quite sure, but whatever they call them, these patterns. Then you've got those people exiting. So quickly, once you pass this level, once you break above this level, you are going to have an influx of shorts hammer through the books. And then that's creating another problem because you've got people sitting here saying, okay, I'm the taker. I'll take all your shorts because I think this is a smart spot to take an active short. So you have shorts exiting into more shorts, which will exit into more shorts, right? Because then these people will exit their trades into the grouping of people up here. So you've got shorts exiting into more shorts, and these shorts, which are these guys, they move their shorts to here. These guys pick them up. They'll move it every level this thing moves up into these guys, and they'll continuously move it up until there's a level that offsets it where you have longs closing. And you see, that's the key. The key is the longs closing because the longs closing will offset the shorts closing, right? So this is not a testament of, oh, the move is ramping. Now, sure, there are people who will get into this move as it ramps, right? Now let's kind of see how this goes. You see how many shorts just closed and how many new shorts just opened up and then how many of those closed again. But there's no buying logic here. There's no purchasing logic, right? There's no taker logic. There's no maker logic here. This is just simply shorts exiting into more shorts to compound this move into something it's not supposed to be, right? And then so finally you have a target, right? In the end of this whole thing, you have a target. In that's where you have your longs now taking profits. This is the first spot they take profits, right? Into the people wanting to short, right? So then you're going to have the same thing on the other side. You could go Control I and flip this to do the same example, or we can just leave it like this. That's fine. So again, 2 is going to be shorts here. But the difference is you have these people who were this buying segment here has targeted this, and they will sell that. So that will offset the contracts closing, because at a certain point where people just they aren't entering this trade anymore, right? And that's offset by where not only long contracts will close, but profits will be taken, and active long contracts will close and active shorts will open. Closes and active trades get initiated at this level, right? Just like they did down here. And those are your levels. Like, you can take all this stuff away here, take a bulk of those away, and we'll take a few more away, 2 more, and we'll just leave 1 red one, 1 green one here, pink and a green. Okay, we'll leave 1 pink, 1 green. Now you have profits taken from these longs here. You have profits taken properly, right? And then you have active shorts opening here. So green is going to be for active shorts here. It's a little backwards. Usually, typically we would take green for longs, but we've been using green for shorts in this, which is fine. They're shorting into longs. This is why I use green, because the longs are trying to be the takers here, and shorts are the makers. Oh, the other way around. Shorts are the takers, longs are the makers. So then you have the same cycle happening. You have people shorting here, right? And then you have, this pullback happening. You have long positions that are going to start closing. So you have people longing this level. You have people longing this here. You have people longing this right here, thinking this is going to move up, right? So you have new long contracts opening. You have a long contract here, and then you have another long contract here. Do this too. You have long contracts down here that are still open, right? We do that 3 down here. You have contracts all in here. Maybe there's some shorter leverage that didn't get liquidated, so you have levels in here. You probably have about a bunch of them in here, right? Like, there's all sorts of different crap in here that people are going to buy. So you have a bunch of stuff in there. Maybe we'll just move them so we can see these number 4s a little easier on top of the bodies of the candles. That's number 2 right here. And then you're going to have like number 5s in here, all the people who kind of FOMO'd in the move. These are all the long contracts that will be closing. So you see, all of these red ones here are current positions. They are contracts that need to eventually close. They are not actively putting up new contracts. You also have, maybe you would have some people longing here, which would be suicide, but hey, maybe there even is some people longing there, but we won't do that. Where these long contracts from down here have now exited here, you have all these long contracts here that will also short the move to close their contracts as this thing moves down. And then so you're going to have even more new long contracts open all in these regions here. So, you can go number 6 right here. You can have more number 6s here and here and here and here. All these people trying to, buy this big move up, right? They're just buying this move up like it's going out of style, right? So then you have all of these contracts will eventually have to close. So when you get to this point, and for this example, now we know better than that. We know most of these people are getting either liquidated or they are taking a profit loss, right? So we know these guys. So for this example, we can just assume that they'll close right at the middle of the number. So we'll just strike through the number. So you have contracts closing here. You have longs creating short volume there, here, 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 here. The bigger the spread, the more the volume that comes in, because then you're going to have people who are trend players who do this and say, oh, there's a trend here. Let's close these positions down here on trend. The guys who missed the full move, but maybe they take half of it because their whole plan is to just kind of ride this trend as far as it'll go. So when trend collapses, you have an influx of shorts coming in. Then we can see here what's happening, and that's fine. And that's and so that's where these trend players, big ones here, instead of understanding where they should have closed their contract, which is, let's just even say it's here, they closed it there for 0.8 when they could have made an additional 130% here. I think that was 8 to 2.1. Yeah, so they could have made an additional 130% here if they understood the mechanisms of these levels instead of just trying to play a trend. So when we have trend break, you have to realize that trend represents pretty much every contract that starts from this point forth. I would say trend makes up, one moment makes up a bulk of these levels, as to where these are a bunch of little things that move it down towards trend. All of these levels here, these contracts that are closing, are moving it down towards trend. But when trend breaks, then you have people with indicators who are getting out because there's a MACD cross happening. And so the MACD cross happens here. So maybe this person bought here because the MACD crossed, and then they sold here because the MACD crossed on the other side. Because they're just averages over time, right? So that's what it's going to look like. So then they, instead of taking, and I don't even know if they get out there, they probably just got liquidated. Probably a 1 minute candle here, right? It's probably just, you know, somebody had their way and said, yeah, they're just trend players, right? They're just trend players who bought a trend somewhere down here, or maybe they even bought down here. I'm not really sure where they bought. And again, not understanding the mechanism of where this trade is going to go. Simply, they just bought some level, longed it with a large amount, and then they just wait till this moment, and then they just break trend themselves, which is fine. There are traders and algorithms and things like that do that in the market. It happens, right? It's not the correct way to trade. It's highly inefficient, but hey, it doesn't mean it doesn't exist, right? Inefficiency is what makes up our markets, people being inefficient.